So I'm just going to show you the question, which I've now corrected, but this one I'll only load afterwards, right? So this one is only going to be loaded once we're done with this class. So there is question 5, the one that we started on. I guess we're about 2/3 through the question, so it'll probably take us another hour or so. So if you can just correct it in case you've printed it, like I say, I'll load this corrected version to Blackboard after we're done with this class. If you go to the third page of the question, where is that? There we go to the third page where it states required. In the original question, which is the error, you will see there it states prepare general journal entries on the 31st of December 2012. Okay, so that is incorrect. So I've fixed that. That should be prepare general journal entries on the 28th of February 2016. We've seen in many other spots there that is our financial year end. So it's just that little error that I've picked up in the question. Okay, so where did we finish off, ladies and gents? We did the allocation of the various expenses to the cost functions. Then we started drawing up our statement of comprehensive income. Obviously, we did some journal entry changes the balances on our pre-adjustment trial balance. So where did we get to? We did the revenue. We also did the revenue note on Monday, so you know that already. And then we did the cost of sales, and we said you must just be careful in some instances, like in question 1 and one of the other questions as well. There was a write-down of inventory, and that write-down of inventory will then obviously affect your cost of sales. Right, so that is where we finished on Monday. So I guess this is a good time to just take a little bit of a pause and ask whether you've got any questions from your side regarding the first 2/3 of this question. So you can, as usual, you can unmute your microphone if you want to ask it in person. As you remember from that email I sent out yesterday, I'm encouraging you. Mr. Borman is encouraging you, so you are most welcome to ask in person. Any questions? None. Okay, so then let us proceed, ladies and gentlemen. Now, what happens, if you remember when we spoke about the structure of this statement of comprehensive income, so your very first line item will be revenue. Your second line item will normally be if you have any other income. I'm not talking about other comprehensive income. Remember we said on Monday, other comprehensive income represent items which have not been realized, right? But if you've got another source of income that is not part of your revenue, such as, for instance, the profit on disposal of property or something like that, it has been realized, then you'll have a little line there called other income, right? And then you'll include that there. And then in that case, your third line item will be the cost of sales, which we've done on Monday. So now after that, ladies and gentlemen, you are going to simply disclose your various cost functions besides the cost of sales. Now you remember in this particular question, we said the company identified 2 further cost functions, namely a distribution function and an administrative function, right? And then all those expenses that belong in the distribution function have been allocated to distribution cost. And all those expenses that relate to the administrative function have been allocated to administrative costs. So we drew up a little allocation table. So all we need to do now is to go back to our allocation table. There we look at the total for this column, the column that indicates distribution cost. We look at the total that we've calculated there, up all those, and we simply transfer that over to our statement of comprehensive income. So that will be the 1,165,000. Go to our statement of comprehensive income, 1,165,000. But now you must be very careful, ladies and gents. We did mention this on Monday. Mr. Borman also mentioned it the previous week. As soon as you have an expense, or in the case of the nature method, or in this case a cost. In the case of your function method, you have to indicate that as a negative. Ahmed, I will answer your question now. Remember, when we draw up our financial statements, our statement of comprehensive income and the notes, we do not have a debit or a credit side, right? So we've got to indicate here on this statement, the statement of comprehensive income, all our incomes as positives and all our expenses in the case of the nature method, or all our costs in the case of the function method as negatives. Ahmed asks, sir, is our first formal test on this chapter? Exactly, right. Your first formal test will be what we refer to as topic 2 on Blackboard. So that will be the theoretical knowledge of IAS1, which has the title of Presentation of Financial Statements. But then mostly this, what we are doing now, which we call topic 3, which is the practical application of all that information that we've been learning over the last almost 5 weeks, right? How do we apply those principles that we found in the conceptual framework to practical situations when we actually draw up financial statements as financial accountants? How do we apply all those principles that we have now studied and learned that come from IAS1, the presentation of financial statements, in drawing up the financial statements, right? Ahmed, does that answer your question? So exactly right. Your first formal test will be on this spot. So so-called topics 2 and 3, IAS1, and pleasure. You're welcome, Ahmed, and then especially how to apply it. Right. Okay, so now let's go to our next cost function, the administrative function. So we simply go back to our allocation table. We see where did we allocate all the expenses to administrative costs, this column. We've added up all the figures in those in that column. We arrived at a total of 747,000. We simply take that figure, we copy it over. Remember those figures have already taken into account any adjustments that we made with our journal entries, right? So we made the adjustments that came from the journal entries before we did this allocation table. So those are already the adjusted figures. So we copy that 747,000 over to our statement of comprehensive income. There we've got it, administrative cost, 747. But again, important, ladies and gentlemen, it is a cost. So therefore, it must be indicated, it must be disclosed as a negative. And then we said, besides the income tax expense, the other kind of expense that we are not allowed to allocate to cost functions is your finance cost. So we have to go and find the finance cost in our trial balance. So we go up to our trial balance. There we've got it, the finance cost, 9,000 rands. But again, ladies and gentlemen, do not forget about your journal entries. So we'll have to scrutinize our journal entries to make sure that no adjustment was made to that figure. So we can just go and have a look at our journal entries. We already know that from Monday. Where are our journal entries? There they are. Any debits or any credits to finance cost? Nope, 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 nope. So that amount remains 9,000, right? And again, it is a cost, so it must be indicated as a negative. Then we get to our first subtotal for this statement of comprehensive income, which means we draw a line. Ladies and gentlemen, don't be lazy to draw a line, right? I know in an online test you're not going to be drawing a line, but for future when you are practicing accountancy, okay? So you draw a line there to indicate a subtotal. We give that subtotal a name, and that name is profit before tax. So now we simply go and add up all the positives here, and we deduct all the negatives. That gives us the subtotal there. So we see this company has got a profit before tax of 1,079,000 rands, right? Then we show our income tax expense, ladies and gents. Now again, I don't want to sound pedantic, but we spoke about this on Monday. We spoke about this last week as well. We get something called current tax payable. A payable indicates it's a liability. income tax expense means it's an expense. In the fourth term, when we do our statement of cash flows, we'll also encounter a new item that we haven't encountered ever at university in financial accounting yet, which is called the income tax paid. And the income tax paid is not the same as the income tax expense, because the income tax expense, as you now all know, has been calculated using the accrual basis. Whereas when we are talking about the income tax paid, that would have been calculated by using the cash basis. So your income tax paid actually represents the amounts that you have paid over to the South African or the British or whichever revenue service, right? So the income tax expense, ladies and gents, those of you who attended on Monday, or those of you who have already worked through the recording, you will know that there was no income tax expense in our trial balance, right? And we said on Monday that it is very unlikely that a company who makes a profit will not have an income tax expense. Then we went and calculated, well, we didn't calculate it. We will calculate the income tax expense next term. Our second topic of term 2 will be taxation matters. Then we are going to calculate the income tax expense. So we're going to estimate that. But in this particular question, they provided us with that figure, an income tax expense for the financial year ended 28th of February 2016 has been correctly calculated at 302,000. Next time, you will have to calculate that figure. Okay, but here they've given it to us. They've also told us it is correct. So we've made that journal entry. You remember we debited the income tax expense. That is the accrual of the expense. At the same time, we raised the liability, which we called current tax payable, colon, income tax. Right, don't forget the income tax part, because it might, some other current tax payable might relate to value added tax, or it might relate to employees tax. So you've got to indicate it there. As Mr. Borman said when he spoke about offsetting, we are going to disclose them separately. Okay, so far, so good, as I've said on Monday as well. So then we get to our next line item. Again, this is going to be a subtotal, ladies and gents. So we draw a line there, right? We draw a line, that's a subtotal. So we simply deduct the income tax expense of 302,000 from our profit before tax of 1,079,000 rands, gives us 777,000. And ladies and gentlemen, this is a disclosable item. This is an item specifically mentioned in IAS1. IAS1 tells us we must disclose the profit for the year, or if this had not been a full year or longer than a year, then we would have called it profit for the period. But please do not call it profit after tax, right? Because the requirement is to disclose profit for the year. So please, don't lose that mark, that'll be silly, right? And also in practice, don't embarrass every one of us by calling that profit after tax. So that concludes what we refer to as the profit or loss section of this statement of comprehensive income. But as we've mentioned on a few occasions, we are using this, the one statement approach. So once we are done with this profit or loss section, we proceed to the following section, which we call our other comprehensive income section. So this is something you haven't encountered in Financial Accounting 1 yet, but we have discussed all the principles or most of it. I know Mr. Borman is still going to do a reclassification adjustment with you sometime in the very near future. So we give it a little subtitle there, right? We give it a title there, Other Comprehensive Income. And then we said we can get two categories. Some of them may be reclassified to profit or loss in the future, right? We are going to do an example. Mr. Borman is going to do an example of something like, for instance, the a gain on financial investment that the company has made by virtue of its share price rising, and then in a subsequent year they actually sell those shares at a profit. Then you can reclassify that gain, which you have originally recognized as part of your other comprehensive income. You can reclassify take it upwards to your other income, and then recognize it as part of the profit for the year. And then you get certain items which are not allowed to be reclassified. One of them we find in this question where there was an increase in the revaluation surplus. But again, very important, give it that little subheading in each case, right? In each case. So the one that we've encountered here was an item that may not be reclassified to profit or loss, and then describe its nature. Then we describe its nature. So what is the nature of that? An increase in the revaluation surplus. Okay, ladies and gentlemen, that was given to us. They didn't need to give it to us because we also saw that we can go and calculate it. So that will simply be the journal entry that we've done. We've debited building at valuation, which is the increase in the value of the building of 780,000, and then our corresponding credit was to increase the revaluation surplus. And we've said for each such item of other comprehensive income, that in actual fact represents a non-distributable reserve. In other words, each such item will have a column in our statement of changes in equity. Okay, so now let's go back to our statement of comprehensive income. So all we need to do now is just to add up our profit for the year plus any items that form part of our other comprehensive income, and that provides us with that total. Now we've got a line above the total. We should have a double line just below it, and we call that total comprehensive income. Right, so that is our total comprehensive income. So it includes our profit for the year, which we have realized, but it also includes an increase in the value of a non-current asset which we haven't realized yet. We haven't sold the buildings, right? So that cannot be regarded as earned yet, right? We haven't actually realized it. It hasn't been sold, but it does increase the company's equity. Okay, so now once we're done with that statement, what we have to do is to start on our statement of changes in equity. And ladies and gentlemen, just before we go to the statement of changes in equity, we must now realize that the profit for the year is going to be added to our retained earnings, and our retained earnings can be distributed to the shareholders of the company, right? It is allowed to be distributed as a dividend. Remember the way we haven't got drawings in the case of a company. If a company distributes some of their retained earnings, it is done in the form of a dividend that is declared, right? But these items that have not been realized, we cannot go and distribute a dividend based on those amounts because we haven't sold those items, so the profit hasn't been realized. So they must remain as part of our equity as a non-distributable reserve until such time as we actually realize it. Okay, so before we go to our statement of changes in equity, let's have a little pause again. Ladies and gents, have you got any questions on that statement of comprehensive income? Doesn't seem so. Okay. So our next statement, that is also the one they require of us next. There's a certain order in which we compile our financial statements. So if you want, you can go back to your question, what is required. After the statement of comprehensive income, the next thing they require is the statement of changes in equity for the year ended 28th of February 2016. Now, ladies and gentlemen, I'm sort of tempted to ask you a question, but this really is a trick question. I think I might have mentioned it with my first students in Wellington. I probably would have, but I'm not sure whether everybody's got the same point of view. So I'm going to ask you this little trick question. What or where is a good place to start with your statement of changes in equity? What would you think would be your very first step? If you can type something for me there. What would be your very first step that you take when you are going to drop a statement of changes in equity? Okay, I'm not going to spend too much time on that. Ahmad, thank you. This is actually really a trick question. It is almost like saying it tongue-in-cheek, but it is a fact. The first thing that you need to do is to go and allocate a column. You have to go and allocate a column for each kind of equity, right? So if we look at our statement of changes in equity, there we see we've got various columns. So where do we get those columns from? We have to refer to our trial balance. Sometimes we might have made a few journal entries that created a new equity account. In this case, there was one, but it wasn't required as part of the question, but we will see a little bit later what that one was. So we've got to go and identify which items in our trial balance represent equity, because remember the statement's name is Statement of Changes in Equity. So clearly we are going to indicate and disclose the changes in equity, right? It really is what it says. So let's have a look at the trial balance. We said ordinary share capital, that forms part of your equity. We spoke about what share capital is on Monday. The revaluation surplus, that is going to be a non-distributable reserve, so that is part of equity. And then we've got our retained earnings, that is a distributable reserve. That is basically the accumulation of our profits over the various years that haven't been distributed to the shareholders yet. Okay, so those are the three categories of equity that we have, which means we have to design our statement of changes in equity in such a way that each of them has its own column, right? So that is exactly what we've done there. So if we just scroll down briefly again to our statement of changes in equity, there you see we've got a column for the ordinary share capital. We've got a column there for our revaluation surplus, which comes from our other comprehensive income section. And we've got a retained earnings column. And then normally when we have this kind of table presentation, we also provide the users with a total column, right? A total column. Now I'm going to ask you a trick question, but this one I really expect you to answer. Okay, so this is not such a trick question. I just want to test you. If we look at this trial balance, we clearly see their equity, we see non-current assets, we see current assets, we see a current liability there, we see our incomes. In this case, both of those incomes represented revenue. We see our various expenses there. Now, ladies and gentlemen, let's see what answer you give me. If you see a trial balance like this, which includes the expenses and the income, right? Has your books been closed off at the end of the year already or not? You can just say already closed off or not. Already closed off or not closed off yet? Thank you, Kay. Not closed off. Thank you, Glorious. Thank you, Lauren. Thank you, Ahmad. Thank you, everyone. Right, it has not been closed off. Thank you, Campus. Porcy. By the way, I just want to find out sometime whether you actually do some buying on the campus, because then I'm going to come and buy something for you. Anyway, I digress. So clearly, ladies and gentlemen, if you still have your income and expense items that are still going on there, and we know that we've made adjustments to them by means of those journal entries. So clearly, ladies and gents, that means that it has not been closed off yet. Okay. If there had been no income or expense items here, only statement of financial position items, that means it has already been closed off. But that doesn't prevent you from going to make adjustments, because you haven't drawn up the financial statements yet, right? It's only once you've published your financial statements, it has been sent out to the shareholders, it has been sent out to the pension funds and to the revenue service and to the asset managers, then you can't change it anymore, right? Then it's cast in stone. So if you then made a mistake, you'll have to fix it in the next year's financial statements. Okay, ladies and gents, so now let's go to our statement of changes in equity. So now the question I need to ask you here, actually, when we have a look at those various kinds of equity there, I know that they mentioned their 1st of March in the case of the revaluation surplus, retained earnings. 1st of March, we know that we've made an adjustment to the revaluation surplus. Clearly, our profit and our total comprehensive or the profit for the year must still be added there. But that ordinary shares, the ordinary share capital, that is actually at the end of the year. And we must now bear in mind one little thing here that we haven't made a journal entry for, because they only required of us to do the journal entries as at the 28th of February 2016. But here we must take cognizance of this very first paragraph under the additional information, where they said the authorized share capital comprises 1 million ordinary shares of no par value, and they also add their 100,000 shares were issued at 10 rands on the 30th of November 2015. Now, Mr. Bormann always draws that beautiful timeline. I must learn that sometime. But that 30th of November 2015 falls within your 2016 financial year. Remember, your 2016 financial year starts on the 1st of March 2015 and it ends on the 28th of February 2016. So during the course of this financial year, 100,000 shares were issued at 10 rands per share. In other words, the amount that we received from the new shareholders, or perhaps some current shareholders took up some more shares that we've now newly issued. That means we have issued additional shares to the value of how much? To the value of how much did we issue this year? If you can type for me there, please. 100,000 shares at 10 rands per share. Thank you, KA. In other words, to the value of 1 million rands. So the one thing that we've got to realize here, ladies and gents, even, thank you, Sharif, 1 million rand, absolutely spot on. What we have to realize here, that was already journalized on the 30th of November, right? So that was a movement in equity. It was an issue of new shares, right? So we increased our shares in issue by 100,000, and we issued our share capital, the issued share capital, by 1 million rands, right? So clearly, ladies and gentlemen, one more little trick question. So that 5 million that's in our trial balance, is that after or before we've recorded the issue of those shares? If you can just type for me there, please, before or after the issue. Oops, there I made that disappearing trick. After. Thank you, Ahmed. Thank you, Sharif. Thank you, K. Aqua. Beautiful picture there as well of you. I'm so glad when I see your profile pictures. After. So that will therefore represent a closing balance, right? So we'll have to work backwards when we draw our statement. When you draw up our statement of changes in equity, we'll have to work from the total at the end of the year. Balance at the end of the year, we'll have to work back upwards, right? So just remember that one. Okay, so now let's go to our statement of changes in equity. So now we have to start with that 5 million rand balance that we find on our trial balance. That is the closing balance. That is after we have already recorded the issue of the 100,000 shares to the value of 1 million rands on the 30th of November 2015. So we've got to work backwards. So that will be 5 million at the end of the year. We deduct the 1 million of the issued share capital during the course of the financial year, which means that our opening balance on the 1st of March 2015 would have been 4 million. Right. In the case of the other two categories of equity, we were clearly told on the trial balance that those represent our opening balances. So let's go and find them. So the revaluation surplus had an opening balance of 510,000. So we simply copy that over to our first line there, the line that contains our opening balances. In the case of the retained earnings, let's go and have a peek at our trial balance again. And in our trial balance, we'll see, there we go. the retained earnings at the beginning of the year, an amount of 2 million. So we simply copy that over and we paste it in our first line item there under retained earnings. Right, so those are the three opening balances. And then for our totals column, we simply add them up across. Right, so the 4 million plus 2 million gives us 6 million plus 510,000 gives us 6,510,000. So that is our first line item. Now we have to go and see what changed our equity during the course of the year. Now, normally what I would suggest is, before one forgets this, you'll be surprised how easy it is to forget the very first thing that you should actually show here, and that is to transfer the amounts over from your statement of comprehensive income to your statement of changes in equity, right? And now we must remember we've got different columns for different amounts here. Our profit for the year is distributable, right? That will now further accumulate, add to our retained earnings, right? So that amount must go to the retained earnings column, whereas this amount will go to a different column, the column that is headed with the wording valuation surplus, right? If we had another item here, let's say a gain on investment, then we would have had a column in our statement of changes in equity called gain on investment, right? So each of them, your profit for the year, each increase in your other comprehensive income will be transferred separately, and then this one, your total comprehensive income, will be transferred to your totals column, right? So it's 777,000 that goes to our retained earnings. So let's scroll down. Oops, that was too far. There we go. So there we've got the 777,000 under the retained earnings, and then we've got that 780,000. Where did we? Cat away. Where's my statement of comprehensive income now? There. So there we've got the 780,000. That is the increase in the revaluation surplus that goes to our revaluation surplus column, and the total of 1,557,000 will then end up in the totals column, right? So that is what we have there. There's our revaluation surplus column. There's our retained earnings column, and the amount with which we increased that column, and that is the total comprehensive income. Also note, ladies and gentlemen, that we only use one line item for this, and we call that total comprehensive income. So we're not going to have a separate line item for the profit or loss, right? Please, I know that in financial accounting we transferred our profit or loss over to the statement of changes in equity, but that is because in financial accounting we did not have other comprehensive income, right? So now we do have other comprehensive income, so we're not calling that profit or loss for the year anymore. We're calling that total comprehensive income, and in the same line item we carry over all the amounts that affect our equity, right? Each one to its own specific column. I'm hearing a few let me just have a look at those questions. Okay, looks like you've all answered it yourself, right? You all answered it yourself, so it doesn't look like I need to answer anything. Well done, well done. That is best, you know, when you learn from your peers. That's perfect. That is the best way of learning. Okay, so now we've got to see what else happened during the course of the year. We've already seen that 1 million rands worth of shares, the 100,000 shares that were issued at 10 rands each, that has changed our ordinary share capital. But there was something else that we also recorded as part of our year-end journal entries that had an effect on our statement of changes in equity. So if we can just have a look at our journal entries here. The way we normally do this, ladies and gentlemen, we are going to get some more complicated statements of changes in equity next term. Once we do share capital, we'll see there are issues of various classes of shares. There can be buybacks of ordinary shares. There can be redemptions of preference shares and so forth. So there can be a lot of items. But then you'll see the way that we do that, ladies and gents, is to again scrutinize all our journal entries. And when we scrutinize our journal entries, we identify each journal entry that has an effect on our equity. So we could have seen here already in the first journal entry that the credit has gone to a revaluation surplus. So we know that belongs in our statement of changes in equity. Here there was no leg of the journal that related to our equity. There neither, but here we've got one. The ordinary dividends declared, we know that is the method by which a company distributes its retained earnings. So therefore that also affects our equity, right? And there in the second line we've raised the liability. So that one must be included in our statement of changes in equity. So if we scroll down to our statement of changes in equity there, we see there ordinary dividends. Some companies will state their ordinary dividend declared. It's a matter of choice, ordinary dividend or ordinary dividend declared. Now, ladies and gentlemen, very important here. When you declare a dividend, you are not buying back any shares. You are simply distributing your retained earnings. So therefore, you cannot indicate it under your share capital column. The only items that will appear under your share capital column is when you issue new shares, which will increase that, like we've seen in the last item there, or when you buy back or redeem shares, when you actually refund the money to the shareholders and you withdraw those shares from the market, right? But a dividend is a distribution of retained earnings, right? So some of your accumulated profits are being given to our shareholders, right? So that will be a negative again, ladies and gentlemen. You are distributing it, so your retained earnings becomes less. So that will be a negative there. And then it is simply a matter of adding up the columns. This one we added up backwards because of the reasons we've spoken about. This you will add up obviously from top to bottom, add up that one, add up that column, and then, ladies and gentlemen, what you always do in financial accounting, if you're practicing as an accountant, you'll go and cross-cast it, you'll go and cross-add it, or cross-foot it, as they sometimes call it in auditing. So you're also going to add these three columns up across, and that must also give you that amount. So in other words, adding it up in columnar form must give you that amount, and adding it up across in the line must also give you that amount. Then at least you know that you haven't made any calculation error on this particular statement. Okay, ladies and gents, so once we are done with our statement of changes in equity, the next statement we'll draw up will be our statement of financial position. If we're unsure of that, we can always go back to the requirement part of the question. After that statement of changes in equity, that is exactly what is required. So now we must prepare the statement of financial position at the 28th of February 2016. Okay, so just before that, let's just have a little pause again. Let's see, are there any questions from your side? Mr. Sharif Malik has got one question there. So are you only sharing your profit with the dividends? Sharif, remember your shareholders. You remember we spoke about this on Monday to quite a large extent. Your shareholders are the owners of the company. They share in the ownership of the company, right? One shareholder may own 1,000 shares. Another shareholder may own 5,000 shares. Another shareholder, it could be a natural person, or it could be another company or an institution or an investment manager. They may own 50,000 shares in the company, right? So that is, as you remember, when we are going to distribute our profits, we declare dividends. And we declared those dividends in cents or rands per share, right? So that person that owns 50,000 shares will get 10 times more dividends as that person who owns 5,000 shares, right? Simply because that owner has got 10 times more shares in the company, right? And the method, the way in sharing that profit is by declaring a dividend. Does that answer your question, Sharif? Hopefully it does. Any other questions? I'm just looking at the chat box there. I can see Lauren and Glody and a few others there have been answering or posting questions and answering them. Thank you all for that. Okay, perfect. Thank you, Sharif. So now we've got to go to our statement of financial position. This is very similar to the one that we've drawn up in Financial Accounting 1. So there shouldn't be any mysteries or surprises for you in there. So let's go to our statement. As you know, we've got two distinct sections. First, we've got a section that deals with all our assets, right? All the assets. And as we've now seen in the theory part of IAS1, when it comes to assets and liabilities for that matter, we have to have a distinction between the non-current and the current. So the non-current assets and the current assets, and we work through a definition what is meant by a current asset. Also, what is meant by a non-current asset? Well, the non-current asset was that easy definition. A non-current asset is any asset that is not a current asset, but there are those four possibilities when it came to current assets. The same applies to liabilities. We also have to distinguish between non-current and current. Okay, ladies and gents, now you remember we spoke about various possibilities when it comes to non-current assets. We said there could be property, plant, and equipment. Those are most of your tangible assets. You can have intangible assets like patent rights and copyrights where you earn royalties from. You can have financial assets such as long-term monetary investments or shares that you own over the long term in another company. You can have biological assets such as sheep if you are a wool farming company, or your vineyards if you are a wine farming company, and investment property. So now we've got to go and see what categories of non-current assets does this company have. So now we go to that non-current asset section of our trial balance. So let's start with land. Now you can use the abbreviations here when I ask the question, but please, ladies and gents, when you answer questions in an exam or in a test, do not use abbreviations. That is important because, you know, as we always say, you must prepare your financial statements and the notes so that it is ready for publication. And those people, the printers and the company that's going to publish it for you, they are not going to correct your mistakes. You know, if you just write in your financial statements PPE, they might think, oh, maybe we should write it out, and they might then say personal protective equipment. And that is not what this is, right? This is property, plant, and equipment. Okay, but anyway, let's just go and have a look. First one we see there is land. What kind? You can type for me there, of those 5 categories that I've mentioned. What category of non-current asset does land belong to? Intangible assets, financial assets, property, plant, and equipment. For that, you can now type PPE. A lot. Thank you, Lauren. Thank you, Lauren. On fire as usual. Thank you. Oh, so quick. Somalingaye, Ahmed, Sharif, Sichaba, Arituma, Nokupiwa. Thank you all. That is part of PPE, right? So that we will include in our property, plant, and equipment note. And we're going to have one item on the face of our statement of financial position that includes that. So let's go to the next category there, buildings, right? Buildings. Again, if you can type for me, which category of non-current asset does that belong to? Yes, you must type it again, please. Again, thank you all. You fantastic. PPE, property, plant and equipment, exactly right. There we go. Okay, so we know that is the same category of non-current asset. Let's go to the next one. There we've got equipment, the cost account and the accumulated depreciation account for equipment. So which category of non-current asset does equipment belong to? You've already started typing there. Thank you. Also PPE. Thank you all. Also property, plant and equipment. Right. If there had been an item such as investments there, investments in other shares or in 12 months, not a 12 months, a 24 months fixed deposit, then we would have known that is part of your financial assets. Or if this had been if this company had also had some farming activities, you had vineyards and you had sheep, or they dairy bell and they've got cows, then you would have known that is part of your biological assets. So all the non-current assets that we have here, they all belong to our property, plant and equipment. So in order to determine the amount that we are going to disclose on the face of our statement of financial position, all we need to do is add up all the debits, the cost of land, the valuation of buildings, the cost of equipment. Those are the three, right? And then we deduct from that our accumulated depreciation on the buildings and the accumulated depreciation on the equipment, right? And that will then give us the amount. So if you can add up those three figures, deduct those three figures, let's just see what you get. Remember, if we had been required to calculate those depreciation amounts for the year, like we are going to be doing in the third term, then you would still have had to journalize it. But we'll only do those journal entries in term 3. So if you can add that up, what do you get, ladies and gents? If you can type a figure for me there in the chat facility, please. Thank you, Lauren. Remember, those would then be financial assets, right? Not finance costs. Finance cost would be in your statement of comprehensive income. But if it's under your non-current assets, that would be your financial assets. Okay, there we go. Let's see who is correct. Who's added it up correctly? Let's go and have a look at our statement of financial position. Still down, still it's below our statement of changes in equity. There we've got it. It should be 8939 000. Let me just see if anybody's got that. 8939 000. Oh, I see. Those of you who've typed there 8049, remember, what mistake did we make now? What mistake? This is something we hammered last week. Now we've got to go and see for ourselves, what mistake did we make? What did we omit? Why do we have 8,939,000 there? 8,939,000. And why do you not get that figure? What have we omitted? What have we left out? We have now taken into account of the accumulated depreciation, but we said when we did the allocation of our expenses and we did the statement of comprehensive income, we said that besides our trial balance, we must also refer to what? There's a second source. Campus Griller, you're correct. So what is that second source that we did not look at now? Our journal entries. Thank you, KA. Exactly, our journal entries. Right. Remember that trial balance that was provided to us is a pre-adjustment trial balance. And then we did some journal entries. So now our post-adjustment trial balance is different. right? It is now a little bit different, so we have to take that into account as well. So ladies and gents, what we have to do is, like we said at the beginning there, we add up all the debits there, we deduct the accumulated depreciation credits there, but then before we go to the statement, before we do that, we have to refer to our journal entries, right? We now have to refer to our journal entries. So let's see whether there was any journal entry that affected the value, the carrying amount of our non-current assets. So let's have a look at our journal entries. There are our journal entries, and there we can see the very first one, the building at valuation. We debited that by 780,000, right? So that building at valuation is not what it was in the trial balance, right? It is not 8 million anymore. It is now 8 million. Where is that figure? It is now 8,780,000. So we've got to add that 780,000 as well. Okay, ladies and gents, if you can type for me in the chat facility now, what do you get after you've added that figure? What do you now get? Thank you, Sharif. Thank you, Lauren. Thank you, Fatima. Now we get that 8,939,000. Right. So there was a little lesson, ladies and gentlemen. Don't forget, every time you draw up the financial statements and you've made any adjustments by means of journal entries, you must take them into account as well. Right. So we always start with our trial balance, but then we've got to go and refer to any journal entries we've made. If you want to be even more complete, you can, after you've done your journal entries, you can draw up a post adjustment trial balance. So there, that 780,000 would have been included. Okay, right. So there we've learned a nice little lesson. So let's scroll down to our statement of financial position again. If there had been any other categories of non-current assets, we would have listed them there. Financial assets, biological assets, whatever they may be, those amounts would be included there. Then we are going to draw an outline around all those figures that are part of your current assets. We add them up. In this case, there's only the one, but remember, if there had been more, you would draw that outline around all those figures in that non-current asset category. You add them up, and you also then disclose that total for that little section next to the subheading called non-current assets. Now, I, as the user, can easily see total non-current assets for this company, almost 9 million, 8,939,000. What does it consist of? Property, plant, and equipment. So it's all tangible, right? And I can have a look at the note. There is a note. We've included the note here. You are not expected to do the note, ladies and gentlemen, but we have included it there. So if I want more information, I can go to the note. You've already done this in Financial Accounting 1, so you're very familiar with this note, right? So this note, again, almost very similar to the statement of changes in equity, we'll have a column. So we start this note by having a column for each class. Mr. Borman explained it so well the other day, right? For each class of property, plant, and equipment, we'll have a column. So here we'll have a column for land at cost, buildings at valuation, equipment at cost. And there we start with our opening balances, and very similar to our statement of changes in equity, there we would have shown all the movement. So we know from our trial balance, that was the depreciation on buildings. There we've got the revaluation, which gives us the closing balances there, right? So just for the sake of completeness, we've added this property, plant, and equipment note there so that you can see where those figures come from. But if they don't require you to draw it up, you can simply add up the opening balances or closing balances that you find in your trial balance. But then don't forget about any adjustments that you've made by means of journal entries. Okay, so then we get to our current assets, right? You remember the definitions, those four components of current assets. Mr. Bormann also explained the other day, there are normally a certain order. There are more than one method, but the most popular method to list, in which you determine the order of listing your current assets, is in order of liquidity. So the least liquid current asset will be at the top, and the most liquid one will be at the end. Right. So here we see we've got inventory. Inventory, the least liquid. You know, when you sell on credit, you first got to convert your inventory to debtors, and then the debtors still have 2 or 3 months to pay before it gets converted to cash. So inventory, your least liquid asset, current asset. So let's go and have a look at our trial balance. There we've got inventory 350,000. But ladies and gentlemen, let's not do the same as we've done 5 minutes ago. Let's refer to our journal entries. Have we made any adjustments to the inventories account? Remember, like I said earlier in question 1, and I think it might have been question 4 if I'm not mistaken, in both of them there's a write down of inventory, which then clearly reduces the value of your inventory. So now we can look at this question. Nope, no changes to inventory. Nope, nope, nope. Right, so that 350,000 in this case we can copy over. We take that to our statement of financial position under current assets. We disclose it as inventory, or we can actually disclose it, if you wish, as inventory. In fact, you know, I tend to use the term inventory, but I think inventories is actually a better description. I'll tell you why it's a better description. The IAS, the IFRS, the IAS2, which deals with that, is actually titled inventories. Okay, so that is possibly, it is definitely a better description. I'm so guilty myself, I very often just call it inventory. So the second least liquid one is our trade and other receivables. Now, strangely enough, this is called trade and other receivables, but we see that they've got expenses paid in advance as a separate item there. I guess that is probably because we've done a journal entry for that. But you could have included those expenses paid in advance amongst your other receivables, right? So that you could have left that line item out, and you could have disclosed trade and other receivables as 301,000. Okay, so that would also have been correct. So if we have a look at our trade receivables there, where do we find it? Here we've got accounts receivable in our trial balance, 271,000. Again, don't forget to refer to the journal entry. So did we make any adjustment to accounts receivable? No, none there, none there, none there. That amount will remain exactly the same, right? Like I say, if you want, you could have just shown the prepaid expense or the expenses paid in advance as part of that line item, the other receivables. Okay, so that 271, we forget that from the trial balance, but we did refer to the journal entries just in case, right? We did not have expenses prepaid or expenses paid in advance on the trial balance, right? So it appears nowhere amongst our current assets. But now, again, we must refer to our journal entries as well. And you'll remember we raised a new journal entry. We had an entry there where we debited expenses paid in advance, which we now know is a current asset. And we took that out of our salaries and wages because that was an advance on the salary that somebody requested there, right? So that is where that amount from, right? The expense paid in advance. So we simply take that to our statement of financial position and show it as a separate entry. Personally, I would have included it in the trade and other receivables. Or if I wanted to show it separately, then I would have called that trade receivables, that one. I would have left that out, and then I would have disclosed the expenses paid in advance separately. And then lastly, we've got our cash and cash equivalents. So let's go and have a look at our trial balance again. What did we have there? Amongst our current assets, accounts receivable, inventory, and bank. We had a bank account, so we didn't have a petty cash or a cash flow. That is the only one. So if it's a bank account, it will, and it's the only account, that would normally be a current account. So that will qualify as a current asset. But remember, any of those bank accounts that are not regarded as financial assets, as well as your cash, like a petty cash flow, you will add them all together and you will disclose it as cash and cash equivalent. Don't forget that term, ladies and gentlemen. It is also a term used in IAS1. It's also a term, as a matter of fact, used in IAS7, which deals with the statement of cash flows, right? So it is important that we become used to that term now. Okay, so once we've listed all our current assets, simply what we do, first of all, we draw an outline, right? You draw an outline. If you are using Excel, you're going to go to, what is it? I think you're going to go to Format, Cells. What is it? What is your next button? Format, Cells, Borders, and then you get an option called Outline. So you'll draw an outline there, and then you'll add up all your individual figures under your current assets, and you indicate or disclose the total of your current assets next to the subheading called current assets, right? And then lastly, you add up your non-current assets, the total non-current assets, plus your current assets. That gives you your total assets for this company as at the 28th of February 2016. So that is our asset section. Then we've also got a section that we call the equity and liabilities section. Now, this really isn't rocket science. You know from Financial Accounting 1, you know that your assets, that's the accounting equation, isn't it? That's the accounting equation. Assets equal equity plus liabilities, right? So if on the one section you've got your assets, then the total must agree to the other section, which contains your equity and liabilities. So we see there are three little sections. So we start off with our share capital and reserves. Share capital and reserves, 9,042,000. Where do we find that, ladies and gents? That is simply the total of the total column of your statement of changes in equity, right? So that is the total of the totals column of your statement of changes in equity. So go back to our statement of changes in equity. That is the statement. There's the totals column. What is the total or the closing balance there? 9,042,000. Right. So we're going to copy that over. We're going to take it to our statement of financial position. We're going to describe it as our share capital and reserves. I also saw some companies recently. Some companies sometimes refer to that as their issued share capital and reserves. So you can also refer to it as your issued share capital and reserves. I personally don't think it's necessary, because everybody who knows anything about accounting will know that you cannot disclose your authorized share capital here unless they have been issued. So by definition, this has to be your issued share capital and the reserve. So your share capital will be your different classes of share capital. Ordinary share capital, like we had in this question, and then next term we're going to encounter another class of share capital, which we refer to as preference shares. We'll have a different column for them, and your reserves will in effect be your distributable reserve, which is your retained earnings, and then anything else that is regarded as an accumulation of other comprehensive income. There you might have gain on investments, or you might have what did we have in this one? The revaluation reserves. So there are many that can be included there. Then again, in the order of liquidity, we start off with the least liquid one, which is our non-current liability. So now we've got to go and see, did we have any non-current liability? So that would normally be something like a loan or borrowings or debentures or bonds that the company has issued or has in issue at the end of the year. So if we move back to our trial balance, we look at, amongst our liabilities. There we can see just below our non-current assets, we've got an account called long-term borrowings, and the amount is 110,000. So just to make doubly sure that we haven't made any changes to that figure, we briefly scrutinize our journal entries again. We see we made no change to the long-term borrowings. If we had, then we obviously would have had to take that journal entry into account. So that amount we can simply go and disclose under our non-current liabilities, 110,000. Right. If there had been any other categories of non-current liabilities, again, we will list them there. We will draw that outline around all of them. We add them up, and that gives us the total non-current liabilities, which we then disclose next to that heading. There is one of the questions, I can't remember now which one. I think it was one that Mr. Borman did, where there was a portion of that long-term borrowings that became repayable within the next 12 months after the financial year. So clearly that portion of the capital on that loan that has to be repaid within 12 months after the financial year is not a non-current liability anymore. That portion will then be a current liability. So we will take that portion out of the non-current liabilities, and we'll have a new item under current liabilities called not short-term loan. It's still a long-term loan, but it's the short-term portion of that long-term loan. We'll call it the current portion, or the short-term portion, if you wish, of the long-term borrowings. Okay. Anyway, so that is our liability, our one non-current liability. Now let's go and have a look at our current liabilities, ladies and gentlemen. So we go back to our trial balance. Fortunately, they've grouped them very close together for us. So the only one that appears on our trial balance here is the accounts payable of 141,000 rands, right? But remember, we must still just go and have a look at our journal entry. Did we make any change to our accounts payable? Let's have a look. No. Right, so we have no change was made to accounts payable. So we can simply go down to our statement of financial position. There we've got our trade and other payables, 141,000. Right. So that was the only one that appeared in our trial balance. But now we've still got to go and scrutinize our journal entries. Did we by any chance raise any further current liabilities? Let's have a look at our journal entries. Right. Let's have a look. Let's have a look at the first one. Now I think I must take a little breather here, and you give me a few answers. That first entry, does that have an effect on your liabilities? Yes or no? No, thank you, Aqua. No, the debit has to do with your non-current assets, and the credit has to do with your equity, right? So that had no effect on your current liabilities. Let's have a look at the next one. Expenses paid in advance and salaries and wages. Does that have any effect on Where's everyone? Does that have an effect on your on your current liabilities? Is any one of those? Yes, Mr. Borman.
You've asked a question and then you've broken up, and we couldn't hear what you were really asking. So just ask your question again, please.
Thank you for that. I'm sorry, guys. Like I say, my internet has been iffy most of today. It's not normally like that. I'm not sure why it is. Okay, so my question was in that second item. I see some of you have now answered this, so some of you may have heard that. That second journal entry, either of those legs, do any of them have any bearing on your current liabilities? And Sisonke and Sunai has already answered there no and no, sir, respectively. Thank you very much. The debit there is a current asset, and the credit there is an expense that was reduced, right? So that had no effect on our current liabilities. So let's go to the third one. And I hope that was the last time I lose my internet for the day. The next one, does that have an effect? Yes or no? Yes. Thank you, KA. Thank you, Sisonki. Thank you, Fatima. Thank you, Aqua. Yes. The debit we know is an expense. We accrued that income tax expense, but as we said at the time, we also raised the liability towards the tax authorities, right? So that credit, the current tax payable income tax, there we raised a new current liability. So that one, we mustn't forget about. That one we must go and include in our statement of financial position. So there we have it. We describe it exactly as such. Current tax payable, current to distinguish it from deferred tax, as we said the other day, income tax to distinguish it from perhaps value-added tax or employees tax, and there's the amount that we have raised. So let us not forget our journal entries. So let us go back to our next journal entry, the last one there, where we recorded the dividends declaration. Does that affect our current liabilities? Yes or no? KA says no. Equity. Aqua says yes. CPUT says yes. Sinelizwe says yes. Now, just be careful, ladies and gents. Remember that journal entry has got two legs, right? The debit side, as KA correctly stated, that affected the equity, right? That affected the equity. But what about the credit side? The credit side, we said when we declare the dividends, we record the distribution by debiting the ordinary dividends or ordinary dividends declared. At the same time, we raise the liability towards our shareholders, in this case, the ordinary shareholders, right? So that leg, the credit part, like Aqua and CPUT and this we said, that is in actual fact a current liability that we've raised. Remember, sometime after the year end, we are going to have to pay the dividends to those ordinary shareholders. So there we have raised a liability towards our shareholders. That is why that is called ordinary shareholders and not ordinary shares or ordinary share capital. So that debit side does affect our equity, right? That is a distribution of retained earnings. But the credit side is the raising of the liability. So that 25,000 must also be included here. We describe it, ordinary shareholders for dividends. I'm going to take that for dividends out because sometimes you might, there might be a buyback of shares and you may owe them money for the buyback as well. So we'll just call that ordinary shareholders, 25,000 rands. Right. Now that we've looked at all the current liabilities in our trial balance and we've scrutinized, we've gone through the whole set of journal entries that we've done subsequent to that trial balance, now we are satisfied that we have actually disclosed all the current liabilities. So again, what we do, we draw an outline. We draw an outline around all those current liability figures. We add them up. So we add those three amounts up. That gives us the total current liabilities. And then we disclose that next to the heading that reads exactly that current liability. So once again, on one page, the users of the financial statements can get a picture snapshot of what the financial health of this company is. What is the financial position? What is the value of their non-current assets? What is the value of their current assets? And there might be certain items that are more liquid than others, right? What is the value of their non-current of their current liabilities? Beautiful, beautiful. It's a piece of art if you're an accountant, right? Beautiful. Okay, so let's pause there, ladies and gents. Any questions from your side, either in the chat facility or if you want to unmute your microphone, you can ask it in person. You know the drill. Okay, so then all that is left for us are the notes. So let's go and have a look at the notes. We're not going to disclose all the notes that are required here yet. Some of them we are only going to learn about next term. And the property, plant and equipment note, you already know. So the notes that we are going to look at are the statement of compliance, first of all. Then amongst our accounting policies, the basis of preparation. We've already done the revenue note on Monday, but then we're also going to look at the profit before tax note, right? The PPE note, you know, like I say, and we're going to revisit that in the third term. The share capital note, we're going to analyze and we're going to compile in its entirety next term when we do share capital. So let's start with the statement of compliance. Now, you remember when we went through the theory of IAS1, we said that IAS1 requires a company to state the fact if they are compliant with the IFRS, right, with the International Financial Reporting Standard. So this is a positive statement that you make as an accountant. So let's go down to our notes. If we go down to our notes, it'll come just after our statement of financial position. Then our very first note is titled of compliance. So the positive statement, ladies and gentlemen, we say the financial statements or the annual financial statements have been prepared, or you can use a different verb if you wish, have been drafted or have been drawn up if you wish, something that describes what you have done. So the financial statements or annual financial statements have been prepared in accordance with International Financial Reporting Standards, and please write it out. Okay, write it out. Don't just say IFRS. Once again, we can't expect non-accountants to know what all our abbreviations stands for. Same with PPE, right? Many people who are not accountants will think it stands for personal protective equipment, but we as accountants, we know we use that same abbreviation for property, plant and equipment. Also, ladies and gentlemen, this is quite a common mistake that students tend to make. Remember, you are not teaching the users of the financial statements how to draw up financial statements, right? You are telling the users how you, as an accountant, you have drawn up the financial statements. So you're not going to state there the financial statement should be prepared in accordance, because then you're teaching the other people. That's not your issue here. You want to tell them what you as an accountant has done. So you make a positive statement. The financial statements have been prepared in accordance with International Financial Reporting Standards. Okay, please, that must be clear. Then we get to our various accounting policies. We're going to look at the property, plant and equipment one. In the third term, the inventories one, we're going to look at, you've already basically looked at in financial accounting one. So the first amongst our accounting policies is normally our basis of preparation. They are, in a very basic set of financial statements, there are at least two facts that you have to disclose. This is your measurement basis, right? Or measurement bases, if you wish. And then you also have to indicate whether those policies are consistent with previous years or whether you have changed any of that. So a typical basis of preparation note will look like this: the financial statements or the annual financial statements. Now, this is not a statement of compliance. You're not referring to the IFRS. You are referring to your measurement basis or bases. Now, in this case, you'll remember the equipment and the land has been valued on the cost basis, whereas the buildings have been valued on the evaluation basis. So there are actually two bases being used by this company. So we're going to describe there the financial or the annual financial statements have been prepared on the historical cost basis, except for the revaluation of certain non-current assets. You can actually be specific here as well. You could have said there, except for buildings which use the revaluation method, right? Then you're even more specific. I would say that's an enhancement of your basis of preparation note. So what I would have said is the annual financial statement been prepared on the historical cost basis, except for buildings, which are valued on the revaluation method. If you had changed that during the course of the year, then you would have now stated that one of those bases have been changed. But we will not expect that from you in Financial Accounting 2. I think in Financial Accounting 3, there are a few weeks where accounting policies are being discussed. So in our case, for our purposes, we're going to say it hasn't changed this year. So we're going to add a second sentence there. These policies, in other words, those measurement bases that we've mentioned there, are consistent in all material respects with those, or the, I think that should be those, with those applied in previous years. Right, that is our basis of preparation notes. We've already done the revenue note, so we said we're going to have a little introduction there, and then we're going to list our sources of income, dividend income, interest income. The only one that we must still have a look at is our profit before tax note. Let me just have a look. I heard something in the chat box. No, sorry, it was an email that.
Yes, Mr. van Rensburg, just repeat the section on revenue, please, because you were breaking up again. Thanks.
This internet. I hope it's fine by tomorrow. So the revenue note, which we discussed on Monday, we said we start with a little introduction. Revenue consists of, or revenue comprises, and then we just list our various sources of revenue, whether it's from sales of goods and the amount thereof, whether it's from services rendered and the amount thereof, whether it's from royalty income if you own intangible assets and the amount thereof, the revenue from dividend income if there had been any, the amount thereof, and your revenue from interest income and the amount thereof. And that total for that note must be what you disclose as revenue on the face of your statement of comprehensive income, right? So revenue, highlight that whole line, revenue, total revenue, 10,500,000. Then we get to the profit before tax note, ladies and gentlemen. Now, let's perhaps just discuss why it is called the profit before tax note. Because the strange thing, students always think because it's called the profit before tax note, there must be a profit in there, which there are not, or there must be tax in there, which there are not, right? So there's no profit in the profit before tax note. There's also not any tax in the profit before tax note. So why is it then called the profit before tax note whatsoever? Is because we've got a line item on the face of our statement of comprehensive income. There, where, there. There. We've got the description profit before tax. Now the whole purpose of that note, ladies and gents, is to go and indicate to the reader or the user of the financial statements any material expenses, right? Expenses that you regard as significant enough in nature or significant enough in value that you believe to be regarded as material. In other words, that could change or influence the economic decisions made by the user. Statement. Included in the distribution cost and included in the administration cost.
Mr. van Rensburg, just repeat this part on from profit before tax. You were breaking up a bit. Thank you.
Again, yeah, I can see here on the indicator for my internet, it's coming and going. I'm not sure up to what point you are able to follow me, but let's just maybe then talk about the profit before tax again. The profit before tax note. Why is it called the profit before tax note? Because it refers to this line item which we find on the face of our statement of comprehensive income. And then we must realize that many of the various expenses have been allocated to cost functions. They've been allocated, there were salaries and wages, there was depreciation and so forth. They are not appearing here on the face of our statement of comprehensive income by virtue of their nature anymore, but they could be regarded as material. If you as an accountant believe that they are so significant in nature or so significant in value that it could influence the economic decisions made by the users of the financial statements, then clearly we have to disclose their nature as well. And that is what this profit before tax note is about. That is to go and disclose those expenses that have been allocated to cost functions, but now we're going to disclose them by virtue of their nature as well as the amount involved. Right. Now, we've spoken a lot about professional judgment the other day, ladies and gentlemen. So this is really a matter of professional judgment. In the old days, before the 2008 Companies Act, excuse me, when we still had the Act number 61 of 1973, the 1973 Companies Act, there they had a Schedule 4. There was a whole schedule that instructed accountants what needs to be disclosed in this profit before tax note. We haven't got that Schedule 4 to the old Companies Act anymore. So now it is a matter of professional judgment. So here we've got to decide, what do we see as some things that could be of interest to the users of the financial statements. Normally, ladies and gentlemen, when it comes to the nature, it is something that is of a slightly different nature than the ordinary day-to-day thing, right? Or when it comes to the amount, it is really a hugely significant amount. So the ones that we've decided to disclose here, before we get to them, remember this also has a little introduction. Don't forget your little introduction. It is simply good style. So you're going to say the profit before tax, in other words, that line item on the face of your statement of comprehensive income is stated or has been calculated. Again, you can play around with the verb as long as you don't mess it up. Okay. After the following items have been taken into account. So we simply say the following items have been allocated to cost functions. They've already been taken into account. We cannot deduct them anymore. But in our opinion, as accountants, we feel they are material enough in nature or material enough in amount that we think you should know about this, right? So the ones that have been disclosed separately here in our profit before tax note are the depreciations. The depreciation on the building of 340,000. You remember we didn't have to do the journal entry. It was in the trial balance there, the depreciation on buildings and the depreciation on the equipment. Why would we see that as possibly material in nature? Because it's one of the very few expenses that you do not pay for. You cannot go and buy depreciation, right? So it is an expense. It is an expense because it represents the usage of your non-current assets, but it does not involve you paying for it. So it does not involve the flow of cash. So that's why it's slightly different. In questions 1 and I think 3 it might be, you had a write-down of inventory. Now, a write-down of inventory is a very unusual event. I mean...
Okay, ladies and gentlemen, let's just wait again a little bit for Mr. van Rensburg. In the meanwhile, let me just say, if there is a situation when there is a profit before tax note, where there's an income disclosed in the profit before tax note, then you would put that income in brackets. So the expenses are positive figures in that note, profit before tax, depreciation on equipment, a positive figure. But then as soon as there's an income which is applicable, you would say profit on sale of equipment and in brackets 20,000 Rand. Now, let's just see if Mr. van Rensburg, it seems to me he left the session again. I would just like to share a little screen with you now. And we can go to this specific question. Let me just quickly share the screen with you.
Okay, ladies and gentlemen, I'm so sorry. My internet, like I said, has been iffy all day, especially this afternoon. So I was out of Collaborate totally for a while there, but I am now back. I'm almost done in any case. So just with regards to the profit before tax, now just to finalize that, we said that we are going to show or disclose those items that are material in nature, like the depreciations, because it does not involve the flow of cash. Employee benefits expense is normally, by virtue of its value, a company's biggest expense besides possibly purchases. So normally besides purchases, it is this most significant amount, the extent of the expense. So that will normally be shown by virtue of its nature in this note. And like I've mentioned, an operating lease, you could regard that as quite unusual. Depends on your professional judgment. Okay, and then the other one that I've mentioned a little bit earlier, I don't know if I was still online at that stage, is that write down of inventory, because remember, you are not buying in to sell it below the cost. You are buying it to sell it at more than the cost in order to make a profit. So in the unusual circumstances where you experience a write down of inventory, where your inventory became redundant, or for some reason you cannot sell your inventory above the purchase price, then you have a write down. That will also be seen as an unusual kind of event, so therefore important, of interest to the users of the financial statements. They would regard that as something they want to know about, so therefore it is material in nature. KA asks, what does employee benefits expense mean? Okay, it's good you asked that, because I wanted to discuss that, but I actually did forget. Remember, when you have a company situation, your employees do not only get a salary, right? Correct, Lauren, correct. Your employer pays you a salary, you get an amount out, but they've all exactly the fringe benefits or perks, as they always sometimes call it. Perfect. No, I'm still glad you asked, Kay, because I want to discuss that. So it does not only include salaries and wages. We had salaries and wages in the trial balance, but sometimes the company also pays a portion of your medical aid contribution, which means it is a fringe benefit to you. Or the company may pay a large portion of your contribution to your pension fund or provident fund. Then again, it is not a salary that you get out, but it is a fringe benefit that is part of the cost to the company of your employees, right? So the total cost of employees includes the salaries and wages, but also the fringe benefits that the company pays on your behalf, like the company contribution to medical aid, or the company contribution to a pension fund, or the company's contribution to a UIF fund, unemployment insurance fund, and so forth. Okay, so that is why we call it employee benefits expense. Please get used to that term as well, because in the case of large companies, normally there will be fringe benefits as well. Okay, that is really all from my side for this evening. I thought we would be done within like an hour or so, but I see we've got an hour and 3/4. But anyway, now I think you are pretty much comfortable with this particular question. So any questions from your side?
Mr. Faresa, will you just please explain the note on dividends as well, please?
Let me just go back there. Okay, let me just go to the dividend note as well. Let me just share that again. Okay, in the case of this particular question, ladies and gentlemen, we know that the dividend was declared. Now, when it comes to dividends, there are actually 3 stages to a dividend. 3 stages. The first stage is where the directors recommend a certain dividend, right? They recommend that this is an appropriate dividend to be declared, but the directors do not declare the dividends. So at that stage, when the recommendation is done, there is no present obligation to actually declare the dividend. So there is no amount owing to the shareholders, right? So where we have a situation that at the end of the year, an ordinary dividend was recommended but not declared yet, then it will mean we wouldn't have made this journal entry, right? Let me just go back to the journal entries again. This journal entry would not have been made. That journal entry will only be made once we have declared, well, once the shareholders at an annual general meeting or a special general meeting, only once the shareholders have declared it, then the present obligation exists, and only then will we actually record it. So the three stages of the recommendation phase, where no journal entry is made, it's recommended by the directors to the shareholders. Then we get the second stage, which normally takes place at a general meeting. Discuss that recommendation. The shareholders may accept it, or they may want to change it.
Sorry, Mr. van Rensburg, just explain the second stage because you were breaking up again. Thanks.
I can see my internet is flashing in front of me. Sorry about that, all of you. So the first stage is where the board of directors recommend the dividend, but then at the annual general meeting or a special general meeting, the shareholders will discuss that recommendation. So they might say, yes, we accept the recommendation from the shareholders and we declare. The second phase, in other words, is the declaration. And if they declare it, or they might say, we rather want only 20,000 dividends because we want to retain more money in the company, or they might say, no, the company's got so much cash, they can pay us 35,000 rands as a dividend, right? Then as soon as the shareholders approve that recommendation, or they change it, they alter it, but as soon as they have approved a dividend to be declared, then we say the second stage has taken place, which is the declaration. And then we do this journal entry, right? And then the third phase will come later, once the admin is done, once everybody had a look at, well, not everybody, but the accountant, the financial accountant had a look at who are the actual shareholders, then they will do electronic funds transfers of those dividends to the individual shareholders. So those are the three phases. So if the dividend had only been recommended at year end, so we're sitting at the end of the year, the dividend has only been recommended by the directors, it has not been declared at the general meeting yet, this journal entry would not have been amongst our journals, right? But then we must still, it is still information that is important for the various stakeholders in this company to be aware of, right? So then we are going to have an additional note, a dividend. Where are we now? There. A dividend note will say an ordinary dividend was recommended. So ordinary dividend recommended 25,000, so that the users of the financial statements are aware that it has been recommended, but that no distribution for that has been recorded yet, and no liability for that has been raised yet, right? And then also the amount that has been paid, we said there's a difference between a dividend declared and the amount that was actually paid. We're going to do that next term as well. That will then also be disclosed as part of that note. Okay, now I think it's everything from my side. Oops. So let me stop sharing that. And then
just Mr. van Rensburg, so if a dividend is recommended, you will still record it because we have put it in our trial balance. So we have closed it off to our statement of change in equity. Is that correct?
No, if a dividend had only been recommended, we are not going to record it whatsoever in our journal. So it's not going to be part of our books of account, because if a dividend had only been recommended, there no present obligation exists yet. The present obligation to actually pay the money to the shareholders only emanates on the date that the dividends are declared in the second phase. So when the directors recommended, no journal entry is made, but there is a little note just to advise the users that a dividend had been recommended, but it has not been recorded anywhere, and it is not part of financial statements anywhere, except just this little bit of information that it has been recommended. It's only afterwards, once the shareholders at a general meeting declares the dividends, then we make that journal entry that we've just described there, and then it is going to be shown as a distribution, and then we are going to raise the liability. So the recommendation...
Mr. Van Rensburg, can you just scroll up to our statement of changes in equity?
Statement of changes in equity, there we go.
And there you would see we have our dividend, which was recommended of 25,000 Rand.
No, it was not recommended, it was declared. Let me rather type it in there, dividends declared.
Okay.
But remember, these dividends were actually declared, so it is not only the first phase where it was recommended, this was the declaration. I think in the question they mentioned the dividends weren't only recommended, they were declared. Let's just have a look there. Yes, there we go. An ordinary dividend of 5 cents per share was declared, right? So it was declared. If that had indicated the dividends were recommended, then we would have not done the journal entry. So then it would not have been part of our statement of changes in equity. Then it would only be in that little note. So if that had not, if you follow now, if that had read not declared, if that had read recommended, right? Just recommended, then this journal entry, this one would not have been done, right? This one would not have been done. Then in your statement of changes in equity, that would not have been disclosed there, right? Then you only have that little note there. Where is it now? Then you only have the note, a dividend note, where it says ordinary dividend recommended 25,000, right? But it's not in your books yet because no present obligation exists yet. Only once it has been declared.
Thank you, Mr. Van Rensburg. Thanks very much for clearing this out for us.